Okay, we'll go ahead and get started. So again, Dr. Ken Kim tonight here with us from EQIS, which is a wonderful money manager that we use. So I have Ken's bio here, and I was going to highlight just a few things, and I highlighted the whole thing because you are so impressive, Ken. So I'm just going to read your bio because it's amazing. So Ken began his career in finance more than 20 years ago as a research assistant at the PACAP Research Center in Rhode Island. He has worked as a senior financial economist at the US Securities and Exchange Commission, a consultant for the CFA Institute, a special consultant for the Securities Litigation Consulting Group, and an academic consultant for the Kuala Lumpur Stock Exchange. That's impressive, Ken. He is also a highly accomplished finance scholar and professor of financial strategy, investments, portfolio theory, derivative securities, business economics, and financial risk management. He has held academic appointments at 16 organizations. He holds a PhD from the University of Rhode Island, an MBA from the University of Detroit, and a BA from the University of Michigan. Ken also maintains the FINRA Series 65 license, securities license, and Ken currently lives in China. So impressive, Ken.
Thank you, Kelley.
We are very honored to have you with us, that's for sure, and giving us your opinion of the markets and where you think it's going. So as a macroeconomist, that's your tilt tonight to talk with everyone. And I know I did a webinar recently with Ken and really impressed with how he thinks about things. And what I love about Ken is he makes it easy for us to understand. He's a doctor of economy, that's for sure, but he speaks on the level that I can understand. So thank you for making it easy for me and everyone else to understand. So for people that have questions tonight, we're going to take questions towards the end. If Ken doesn't get to your questions, we'll read some of those off. Please go to your chat and type in those questions, and then we can read them at the end if we haven't reached them already or answered the questions already through what Dr. Kim speaks about this evening. So with that, go ahead, Dr. Kim, and take it away.
All right, thanks, Kelley. So hi, everyone. Ken Kim here, Chief Economist at EQIS Capital Management. And yes, indeed, I'm broadcasting live from Shanghai, China. Well, before I begin, I just want to first say thanks to Kelley Slaught for inviting me to give this presentation. And also, I want to thank everyone who is on this webinar for joining me on this presentation as I give my economic outlook presentation. And so since early this year, right at the onset of the coronavirus outbreak, and until now, I've given a bunch of webinars on the economic impacts surrounding the coronavirus outbreak. And during the entire time, I've been pretty positive in my economic and market outlooks. And that positive outlook continues to remain intact. As you probably know, the economic recovery has begun. So slowly but surely, things are getting better with regard to the economy and the markets. And so in this presentation, what I want to do is give you a quick update. And then I also want to quickly discuss some of the challenges that lie ahead. And the reason why I want to do both quickly is because I want to get to the presidential election, which is right around the corner. So anyway, I think as you guys are well aware, employment numbers are rising. And so this figure shows the percent of people with jobs each month. And this is out of everyone between the ages of 16 and 64 years old, okay, regardless of whether or not they're in school or even looking for work, okay? And so this is one of the most raw and honest ways to show employment numbers. And so I wanted to show this first. And so as you can see, employment has been increasing over the past several months. Now, the unemployment rate that probably you're more familiar with is the one that gets announced on the first Friday of every month. Okay, so this is the more common and more popular way to measure the unemployment situation. Okay, and this is the rate that the media likes to report on. And so as you can see, the unemployment rate has been declining steadily. I mean, we're now at 7.9% unemployment. Now, this is kind of significant because a few months ago, the Federal Reserve Bank, that's the central bank of the United States, predicted that the unemployment rate would be 9.3% by the end of this year. And so we're actually way ahead of schedule, to a lot of people's surprise. I mean, we were below 9% back in August. And so the recovery really has started, and it's actually happening a lot quicker than many people expected. But, despite this, I mean, I know that, despite the rosy employment and unemployment numbers, I realize that a lot of people are still filing unemployment claims. And so that might cause some panic, because we keep reading about the high number of people who are filing initial unemployment claims, and they're doing this, every week. But there is some good news on this front. It's that most of these people who are filing unemployment benefits, not all, but most of these people, were directly affected by COVID. I mean, they were in jobs like hotels and restaurants, in bars and gyms, and et cetera. And so when a vaccine comes out and gets distributed, and we're able to achieve herd immunity, which is something that looks like it might happen in a month or two. I'm not a health expert, but it looks like a vaccine is around the corner. I think we're going to see even more dramatic improvements in unemployment. By the way, before I leave this discussion on unemployment, there is one last comment I want to make about it. I mean, before this outbreak, as you guys might recall, unemployment rate was less than 4%. I mean, it got down to about 3.6, 3.7%. And so people are talking about how we might not get to an unemployment rate below 4% for several years. It might not happen until 2023 or even 2024. And so a lot of people say this is bad news, because it might take 3 or 4 years before we get to unemployment numbers below 4%. But here's the thing. I mean, we shouldn't use a 4% unemployment rate as a gold standard, because the 4% unemployment rate that we were able to achieve was a record. We've never had this before, all right? And so, so we don't need to get back to a previous record. When we were at 5 or even 6% unemployment, we were already saying that this was amazing and this is great, and that the economy was very healthy. Because if you think about it, 100% employment is literally impossible, right? There are people who, it takes some time to find jobs, and, disruption and change can simply cause people to lose jobs and find new jobs. And so something like 5 or 6% unemployment is actually something that's already great, and it's even natural. It might even be optimal. And so I don't think we need to get to a 4% unemployment rate to say that the economy has recovered. I think the economy can fully recover if we get to something like 5 or even 6% unemployment. Retail sales have fully recovered. This surprised a lot of people. A lot of people thought it would take a long time for retail sales to fully recover, but as you can see from this graph, and this shows the total monthly retail sales for the last 5 years, you can see that sales quickly rebounded. And so you see that sharp V-shaped recovery in sales. I mean, I admit that you guys could easily point out that part of the reason why sales quickly rebounded is because unemployed people were literally given money by the government, right? And so, they were able to spend the government's money. But I mean, I honestly believe that as more people go back to work, I think they're going to simply replace the government's money with their own money when it comes to spending. And so I honestly think the sales trend is going to continue.
Let me ask you something here, Ken, if you can go back to the slide. So retail sales have recovered, but people aren't going to stores so much. At least I am California here, right? So I don't know about other states necessarily, because this is a more macro chart you've got here. But is that just more people are buying online, and so that's what you're considering retail sales, or part of the retail sales number?
Exactly. It's exactly the reason why the retail sales have rebounded, because more people are now buying things online. Part of that, that downward spike was caused by people, who had never did online delivery before. And so, they had to now they were forced into the future, I guess, you could say. And, and for that reason, a lot of like the Grubhubs and the, food delivery services and the Uber Eats and Expedia, I mean, those guys had great earnings this year because a lot of people had to embrace something that they hadn't embraced before. And so that was also part of the reason why there was that quick rebound. So it's online orders is the primary driver for that quick rebound. But I will say that retail sales doesn't include food. And so like restaurants, for example. And so restaurants, if I were to include restaurants in here, that V-shaped recovery would look slightly less impressive. But I think we all have to understand that restaurants, I don't think should be included because, a lot of them were forced to shut down. So it wasn't the restaurant's fault. And a lot of them are forced to have social distancing and only maintain a certain capacity. And so it's really hard to blame the restaurants for not having come back when it was largely a government mandate. Let's talk about corporate earnings. So right now it's earnings season. And so like this week and next week, firms are announcing their earnings. Some firms did have pretty good earnings during the pandemic. Like Expedia, for example, or not Amazon. I'm sorry, I meant to say Amazon before. But most firms did not have good earnings. And so the big question is, when will corporate earnings be good again? Will we see good corporate earnings before the year is over? Will we not see good corporate earnings until early next year? I'll be honest about this. I mean, there is some uncertainty when we will see overall good corporate earnings again. And it might not happen until late next year, to be honest with you. But here's some good news, all right? The good news is that, it really doesn't matter when corporate earnings are going to become good again, believe it or not, because the current economic decline that we're experiencing is unlike any recession that we have ever been in, because we know this is temporary. I mean, it's not like the Great Depression of the 1930s. That lasted a decade. And then it's not even like the Great Recession from 2008 and 2009. I mean, that lasted for several years. And, I think if you recall, during that recession, it almost felt like we were never going to get out of it. I mean, do you remember? It just felt like it was just going to last forever. And so we didn't know if there was even going to be a rebound in the near future. And it even felt unlikely. But with the current situation, I mean, given the declining unemployment numbers, we know we're going to have significant economic growth for 2021. I mean, this is inevitable. And so given that the markets, I mean, like we like to say that they're forward looking. They are not just based on current situations, but they also are based on future situations. All the markets need to do is just simply see corporate earnings merely improving. They don't have to be good again. They just need to merely improve, and then the stock prices will rebound. And so this can happen even before firms' earnings become good again, and even before the economy fully recovers. So the market will recover before the economy does, simply because the market is forward looking. Another piece of good news is that stock market valuations seem to be staying afloat despite today. There's a little bit of a down market today.
Volatility every day for the election, I'm sure.
Exactly. Yeah, exactly. So the market valuations are staying afloat despite volatility. But the thing is like I'm sure a lot of people, when they read the news, they've come across an article that say there's this bizarre disconnect between the economy and the markets, that puzzles people. Why are market valuations high? This is crazy when people are unemployed and the economy is down, right? And so people might even see like news articles where they say that the markets are overvalued, and that might cause some panic. But I think, we should all remain calm, because we have to keep in mind that current GDP, which is current economic situation, and current market valuations, they reflect different time horizons. So they don't need to be in sync. Current GDP just reflects the state of this year's economy. But current market valuations, I mean, that reflects companies' present, but all of its future cash inflows. So they're just completely measuring two completely different things, different time horizons. I mean, out of curiosity, because I'm a data nerd or a stats nerd, I actually calculated the correlation between annual US GDP growth and annual S&P 500 returns for the past 50 years, from 69 to 2019. That correlation is pretty much zero. And so, this is just, when people say that the economy is down and the market should be down too, it just doesn't hold empirically. And one other last point that I want to say about this is that, the markets overall are not really that highly valued. It's only a few sectors, especially tech, that's keeping market valuations high. I mean, for most other firms, they have not fully recovered. And so, when people say that there's a disconnect between the market and the economy, that's just really a gross oversimplification. But anyway, all of this said, I do expect markets to be volatile, as we have seen in the last 2 days alone, and very volatile, especially now, as you pointed out, Kelley. I mean, we have an upcoming presidential election, and so the markets hate uncertainty because they don't know who's going to win. And so the markets, are going to take the occasional tumble now and then, but it's just, I think it's something that, given the uncertainty, I think, that volatility is justified, to be honest with you, and I think it's understandable. This is kind of for fun, but when we're talking about market and economic recoveries, people are wondering, what is the world going to look like post-COVID? And so here are some questions that people might ask. Are people going to still work from home? Because we've kind of gotten used to it, and a lot of people like it. Are people going to work out from home? Because we've discovered that it saves a lot of time. And are people going to be nervous about getting back into an Uber or getting into a subway? Are people going to go back on business trips? Or do we discover that stuff like Zoom, like what we're doing now, is actually not that bad and is just fine? And the other thing is, how about hotels? I mean, after COVID is over, are we going to be nervous about, sleeping in a hotel room where we know people have slept in there before? And then what about restaurants? I mean, are we going to feel nervous about getting back to eating out? And so obviously, I can't predict the future, but China eradicated the virus spread back in April, as we talked about briefly at the beginning of this webinar. And we've been normal for about 5 months now. And so, I mean, China did a hard lockdown, and they were able to pull that off because this is a communist government here. Whatever they say, we have to do it. And so China's situation today, what it looks like today, I could kind of use this to kind of predict what the United States might look like post-COVID. Obviously, we're talking about two different cultures, so we have to take my observations with a grain of salt, right? But in China, the proverbial everyone went back to the office. And so despite what I read about how, engineers like working at home and they're going to be allowed to continue working at home even after COVID, I have some doubts about this, Kelley. I mean, the thing is that—
I'm sorry to interrupt, but I do too, because I work from my office the whole time. I mean,
yeah.
Home is my sanctuary. I don't want to work from home. I could. I don't have kids around me or dogs barking, so I could. But I don't want to meet clients there. I want to have an office. And, doctors' offices, obviously, they have to be able to meet their patients. There's a lot of businesses that really want to have an office to go to. So
yeah.
I think it's interesting in China that people have returned to the office. So yes, of course, some people will probably start working from home, and that's fine. But I think a lot of people want to get back to offices. Yes, I agree with that. So that's interesting.
Yeah, I mean, it's people just got cabin fever. I mean, they want to see their friends again. They want to listen to office gossip again.
Is that what it is?
Yeah, or just go out to lunch with their friends. And so despite what I've read about, and so I do think that this does give some hope for commercial real estate, coming back. I mean, just as an aside. But anyway, and so gyms, by the way, are full again, believe it or not. I think it's because people like going to the gym. And so, I mean, I don't know. I mean, how did you buy an exercise bicycle? I bought an exercise bicycle, but now I use it to hang my clothes on. And so when the gyms reopened, I couldn't wait to get back to the gyms. So gyms are full again. Subways, buses, ride shares, all that full capacity. I mean, I admit, like when I first got back into the subway, I was scared. But after a couple of times, nothing happened. And, it's just became normal again. And so, and then business travel, by the way, is still down. And so I think it's because, a lot of business trips, I think people realize, a lot of business trips kind of seem not as important as they used to seem. So if people feel like Zoom is pretty good and other kinds of ways to conference call. And so business travel has increased, but hasn't gone back to where it was before. And so this means that hotels are not at full capacity. Business travel is down. But I will say this, hotel occupancy did come back a little bit. And sometimes you can't even book a hotel room. And that might seem weird because business travel is down, but here's what happened. Chinese people are afraid to take international vacations now. And so they're just taking domestic vacations. And so I think what's going to happen with the United States is that hotels are going to come back to some extent. And it's just because Americans are just going to start off with domestic vacations before they start doing international ones. Restaurants are packed again. I think it was, again, a reflection of cabin fever. People just wanted to get out and meet their friends and socialize. But, I just want to point out, Kelley, I mean, this is, take all of this with a grain of salt. We don't want people to start investing, to think that they know the future and start investing.
Let me ask you about China specifically. So China has kind of always worn masks. I mean, I remember always watching Chinese people, particularly wearing masks. So what are you seeing on all of these? Are people wearing masks with all of these, or would that have been a normal thing anyway over there?
Well, I would say, in Shanghai and Beijing and other large cities, I mean, we have a pollution problem. And so, every day, almost everyone will look at their cell phones to see what the weather situation is like, and because they always talk about what the pollution level is for that day. And when the pollution level is high for that day, which happens about in Shanghai, maybe 1 out of every 5 days. In Beijing, it's like 1 out of every 3. I mean, you'll see a high proportion of people wearing a mask. Right now, everyone, I would say, it's about half the people are wearing masks, and the other half, they have a mask in their pocket just in case. So I don't.
Be normal.
What's that?
It'd be normal for you guys to do that anyway.
It is. I wouldn't say it's kind of normal. Let's say, yeah. I mean, a mask is a large part of the culture here, and so wearing masks was not a big disruptor for anyone in China. I mean, I would say that everyone in China has worn a mask, semi-regularly before this happened, and so it was not much of a game changer for us to have to wear that mask. It's simply because in large cities we have that pollution problem to begin with, and so so anyway, so these are just just based on what happened in China. Don't know how much of this will happen in the United States, but so we can just say that this is largely for fun. Anyway, even though the recovery is well on its way, let's talk about some challenges that lie ahead. And so here are 4 challenges that I just wanted to briefly talk about. In the past year, the United States has come out with humongous policy responses, as you guys know. Let's talk about fiscal responses first. This is the several rounds of stimulus and all the other aid that was coming from the government. And hopefully there's another stimulus, or I don't know, maybe not hopefully, but it seems like there might be another stimulus coming out soon. And so we have to keep in mind that this money does not come out of thin air, all right? I mean, we have to be aware of this and cognizant of it. I mean, and a lot of it added to the national debt. I mean, the national debt was already huge before the coronavirus outbreak. I mean, to be honest with you, it was teetering on almost being unsustainable, all right? And now it's become even huger. I mean, it's increased by at least 10% in the past year. And so at some point, the United States is going to have to address this elephant in the room. I mean, it's going to have to do something about it. I mean, what is the United States going to do? The one obvious possibility is that they're going to have to raise taxes. And the thing about taxes is that it's going to be a double whammy for the markets, right? I mean, higher personal taxes is going to reduce consumer spending, and higher corporate taxes is going to directly cut, going to cause some hindrance to market valuations. And then there's the Federal Reserve response. This is the sort of the U.S. central bank. The Federal Reserve was already holding a lot of assets before this outbreak. And now we have, QE infinity, which is quantitative easing infinity. That just means that the Fed will buy as much Treasury as necessary. And the Fed is now also holding corporate bonds, which is unprecedented. I mean, it's kind of crazy. They're almost like bond investors. And they're also holding municipal bonds, which is also crazy. And so they're doing this because they want to make sure that states and cities don't go bankrupt. And so imagine, the Federal Reserve just holding all kinds of debt. It was, their assets were already super bloated, but at some point, I mean, it's now way bloated. At some point, they're going to have to unload some of this. And so when they unload some of this, what's going to happen, of course, is that they start selling their bonds. That means as they're dumping bonds, bond values are going to go down, and rates are going to rise. And when rates rise, that's going to cause some hindrance to stock market valuations. But even though this sounds like bad news, I mean, let's just say this. I mean, there's going to be fallouts. I guess we can call them fallouts once the government and the Fed starts to address or undo, their responses. I don't think, this is the good news, I don't think that they're going to, unravel or undo their responses anytime soon. I think they're going to wait until after the economy fully recovers. So that's the good news. I mean, this year is a presidential election year. I doubt any candidate is going to implement a tax hike anytime soon. The economy can't handle a tax hike right now. I mean, it's still recovering. Even if Joe Biden is elected president, I mean, he's already said that, even though he wants to raise taxes, he's already said he won't do it until the second or third year in his term if he's elected. So he also said that he will wait for the economy to recover first. And so I don't think we're going to see the government undoing their responses until after the economy is recovered. Same thing with the Fed. The Fed has a history of raising rates only when the economy is strong. And so I think given their track record, I doubt the Fed is going to start undoing their responses anytime soon. And so even though, we keep reading about policy fallouts in the mainstream media, I don't think it's going to happen anytime in the near future. I highly doubt it. So I think both the government and the Fed is going to wait on this. Talk about China. Let's just real quickly, let's talk about China and U.S. relations with China. I mean, first there was a trade war, and by the way, this is still a thing. It's still ongoing. It hasn't gone away. I mean, Trump just put it on the back burner. And meanwhile, there's the Hong Kong protests, and by the way, that's still ongoing. I mean, people have kind of forgotten about it because of other things to worry about. And Hong Kong is protesting China's control over it. And the thing is, the United States seems to be on Hong Kong's side on this. And then there are, of course, tensions because of the coronavirus, because there's finger pointing there. And then there's accusations over security concerns. We're talking about the TikTok, the Huawei, the WeChat, and embassy closures and all of that. And so here's the thing, a lot of these tensions are politically charged. Right. And so, at the end of the day, I mean, I honestly believe, and I think everyone, believes this too in the back of their minds, that the United States, despite whatever anger, they have, with China, they're going to be rational. I mean, they're going to do what's best for the economy, for its economy. And I think the government is going to do what's best for the economic welfare of the American people. And they're not going to let, anger and emotions like interfere with this objective. And so given this, I do think that US-China relations will be cordial again and to the benefit of both economies. And a trade deal will get done eventually. I mean, the Hong Kong protests, I admit that's a socially significant issue, but it's not an important global economic issue. I mean, Hong Kong is a small economy. Whatever Hong Kong loses, neighboring countries will gain. And then the tensions with regard to the coronavirus finger pointing and the security concerns, those are largely political issues. And so I think those tensions will blow over. I mean, I realize that both countries right now are trying to become less dependent on each other. And I also think that's a good thing too, to be honest with you. I mean, especially for the long run, because for the United States side, Chinese supplies and labor are not that cheap anymore. And from the China side, China, can't, I mean, it's pretty much a developed economy now. I mean, it can't be like a cheap exporter anymore. It can't be the world's manufacturer anymore. China has to figure out other ways that they need to grow. And so I honestly think at the end of the day, both the United States and China will be better off in the long run as these tensions get resolved and subside. And even when they become more independent of each other, I think they're going to be both better off in the long run. Inflation, people are worried about inflation. The logic here is that for the past years, so much money has been pumped into the economy. And so there's so much money in the economy right now. So, you know, that's going to do some damage to the value of a unit of currency. I mean, with so many dollars out there, how valuable are our dollars now? If they're not going to be that valuable, that's just going to cause prices to rise. And so people are worried about inflation. But let's keep the following in mind before people panic. I mean, first, we have to keep in mind that inflation was super low before the outbreak. We're talking 1%. All right. So inflation has room to rise. And right now, the other thing is, you know, because so many people are unemployed, and in general, you don't see people going out on wild spending sprees, you know, and that also keeps inflation in check, right? And so, you know, I'm not worried about, you know, runaway inflation anytime in the near future. And the thing is this, if inflation did rise later, let's say immediately after this virus outbreak is over, and all of a sudden inflation starts to spike up, you know, it would be very easy for the Fed to quickly resolve it, because right now interest rates are almost zero. And one of the Federal Reserve's strongest weapons to fight inflation is to raise interest rates. Because when they raise interest rates, you know, fewer people borrow because interest rates are so high. And when fewer people borrow, it reduces the amount of currency in circulation. You see what I mean? And so when it reduces currency circulation, then you know, the value of a unit of currency becomes more valuable again, and inflation, you know, will subside. And so, you know, so I'm not really too worried about runaway inflation. And by the way, neither is the Federal Reserve Bank. They're not worried about it either. The Fed recently said that they're going to let inflation go up a little bit, up to about 2.5%, because in their words, they said that this is healthy. I don't think that's what they officially said, but I think what they really mean is that they're not worried that inflation is going to run away, and they actually want to keep interest rates low for now. Because by keeping interest rates low for now, it actually stimulates the economy. I mean, companies continue to borrow to finance their operations and their investments. And so I think this is actually pretty good news that, you know, it came from the Fed. Now, last,
let me interrupt. So I don't think the Fed will increase interest rates that much, or they really can't, because we've got this, what is it, 22 trillion of national debt. If they increase interest rates, well, what's going to happen to the national debt, right? That's going to increase, you know, hugely very quickly. So they really can't. I mean, you tell me.
No, that's an excellent point. That's a very astute observation, because we have to pay interest on the national debt. It's not free. And so, I mean, you know, right now the interest rate is like 0.25%. And if they raise that, it's going to make the financing of the national debt even more. And so probably, you know, they might have to do this in a lockstep fashion where, you know, it may be a year or two from now, you know, taxes will have to go up to finance and repay some of this national debt. And then maybe after that, the Fed can, you know, raise interest rates a little bit. But do keep in mind though, Kelley, I mean, the government gets a pretty good interest rate though. I mean, it's so even if the Fed raises interest rates and then, you know, you and I are affected significantly by it, the government will be affected by it, but not as badly as like you and I and corporations would be. And so it wouldn't be like the sky is falling kind of a scenario. Right. And now, last but not least, let's talk about the presidential election. So I'm going to do this without revealing who I voted for. So some people are worried that Joe Biden is going to win the election. And at the same time, some people are worried that Donald Trump is going to win re-election. And so let's discuss what might happen if either wins. But I'm going to only do this in the context of the economy and the markets and nothing else. And so in academia, it's well known that markets do better under a Democratic president. And this is something that probably you and everyone on this webinar is probably already know this from what you've read or probably from what you've experienced. And here's the thing. Believe it or not, there's no good explanation for this. You know, you might be able to raise the issue of maybe it's because of business cycles, or maybe they have different monetary or fiscal policies. academics have tested, all these possible explanations and they can't find any. And so we now call this the presidential puzzle in academia. Why do markets do better under Democratic presidents? We have no idea. It's just an empirical reality.
Well, that may change because the last, 3.5, 4 years have been very positive for the markets under Trump. So
I know. I'll get to that. Yeah, you're right.
Sorry,
Yep, no, you're right. I'll get to that. So based on a famous academic study that was published in the prestigious Journal of Finance from 1927 to 1998, when a Democrat was president of the United States, the annual excess, this is the extra stock market return on top of the risk-free interest rate, was 11%. Based on that same study, when a Republican was president of the United States, the annual extra stock market return on top of the risk-free interest rate was only 2%. And here's a graphical representation. It's hard to see, but what I have is I have stock market returns under different presidents. Blue, of course, represents Democrats. Red represents Republican presidents. The bars above the solid line represent positive returns, and the bars below represent negative returns. That dashed line is just 8% or 7.5%, just to represent average returns. All right. And so here, and this is kind of fun. I mean, it's when the markets, when President Nixon or President Ford was in office, the markets didn't do that well, as you can see. And then markets were bad under President Reagan's first term. Under Bush Sr., the markets were okay. Let's just say they were kind of okay. And so they were average. And so you'd have to go back to Dwight Eisenhower, to find a time when the markets did well under a Republican president. And to your point, Kelley, I can update this. And so I updated the evidence. And so under George W. Bush, the markets, believe it or not, lost 31% from the beginning of his term to the end. All right. And by the way, if you don't think Bush deserves blame for the 2008-2009 financial crisis, because I don't think that was his fault. And so then the markets were only down 8% prior to 2008, but that's still down. Barack Obama, from the beginning of his term to the end, the markets returned about 150% when Barack Obama was in office, more than doubled, way more than doubled. By the way, if you don't want to give him credit just because the markets recovered from 2008 and 2009, because some people don't think he deserves that credit, which is, I don't want to argue about it or say that he did or did not. But if you don't give him that credit, the markets still are up 50% while he was in office. And then to your point with Trump, Trump is the super notable exception to all of this. All right. And so since he took office, the markets have risen about 50% in the last, almost 4 years. Markets did pretty well in his first year, as you guys all remember. They surged, and they also did great last year, as you guys remember, in 2019. In 2018, I don't know if you guys remember this, but the markets were very volatile, and it ended down about 6 or 7%. And I don't know if you guys remember this, but the reason why is because starting with January of 2018, President Trump embarked on a trade war with China. And so that lasted for 11 months. And so the markets were down in 2018. And then for this year, well, I mean, you already know about this year. And so there's no need to explain this because we've been living this year and it's very recent. And so going forward, all right, the $1 million question or the billion or $1 trillion question is which presidential candidate is going to be better for the economy and markets going forward, all right? I mean, given that the markets did well under Donald Trump, some people are worried about Trump losing the presidency. But at the same time, given that the economy is now struggling and a full recovery might take a while, and given that some people blame Trump for this, some people are worried about Trump winning re-election. And so let's take a quick and general look at what might happen if Joe Biden wins the election and Trump loses. So this is a very general look at how Democrats might affect the economy and markets. I mean, in general, as we all know, Democrats like to raise taxes. And we already know that Joe Biden is going to raise taxes. Sorry about that. There's a doorbell in my background. And so we already know that Joe Biden is going to... Kyle.
Well, good. We get to hear him speak Chinese.
Yeah, that means I opened the door. Anyway, so here's a very general look at how Democrats might affect the economy and markets. I mean, as we all know, Democrats like to raise taxes. Joe Biden has already said that he's going to raise taxes, even though he won't do it right away. If he's elected president, he'll wait a year or two. Democrats also tend to believe that governments should play a large role in society. They believe in big governments. And so that's why Democrats like to raise taxes, because, to finance the government's spending. And finally, Democrats tend to regulate more. They regulate more because they think it's best for society. They feel like, they want to play it safe. And so to play it safe, they want regulations in place. And so the thing about regulations is that it actually impinges on corporate risk taking. Right, so it makes corporations be less, they make them more risk averse, less risk taking because of regulations, and so it actually can hinder corporate profitability. And so the ways that Democrats are with regard to raising taxes and spending and regulating could truly, to be honest with you, hinder economic and market growth. I mean, despite their best, intentions with regard to social programs. But here's the thing. I mean, if Trump is reelected, all right, I mean, and given that the national debt is now huge, and even though Trump says he's not going to raise taxes if he's reelected, I have serious doubts about this because I don't know how else he's going to be able to address the national debt. And then the other thing is, even though Trump is a Republican, he's a unique Republican because unlike other Republican presidents and Republicans in general, he's a spender. Even before this year, he added $2 trillion to the national debt, which is unlike a Republican president. And I'm thinking it's probably because, he's not really a career politician, he's a businessman. And so maybe his mentality is you have to spend money to make money. And so he's a spender. And so he's kind of like a Democrat in that regard. And then the other thing is this, even though Trump is pro-deregulation, which has been a good position, because it's allowed companies to, take risks and add to their profitability. He does have one particular position that is harmful to the markets. And that's his strong anti-China position. I will admit, Kelley, that a lot of his anti-China stance is totally justified. To be honest with you, he is right. He was right to start this trade war, for example, 2 years ago, because China does engage in unfair trading practices. I'm just making sure that the Chinese censorship isn't going to shut me down now for saying that. But he's right about it, all right? So some of his anti-China stance is totally justified. But the thing is this though, Kelley, I mean, it still causes stock market volatility, right? And it still harms corporate profitability. And so given all of this, I mean, based on this kind of an analysis, I mean, the takeaway seems like it might be a wash, right? And so, it might be a wash. Maybe that's a little bit too simple to say. But I think the more important thing is I think it's too unpredictable which candidate is going to be better for the markets and for the economy going forward. I mean, we are now in unprecedented times, and so we don't have any history to really go look back to guide us in our thinking. I mean, given this, I think we can't say for sure which candidate. We can't confidently say for sure which candidate is going to be the best person, which party is going to be the best party to steer the economy through these times going forward. And so, the other thing I want to say is I think it's silly to say stuff like, Republicans are bad for the markets and Democrats are good for the markets. I mean, that kind of stuff is just, silly to say, even though that's the way it's been for a long period of time. And so I think the other last thing that I want to say about this is that don't forget that a lot of people thought the markets were going to crash, when Trump got that surprise election win. People thought the markets were going to crash, and they did crash initially, but then quickly, rebounded. And so I think it's kind of silly to say that the sky will definitely fall if either is elected. I mean, I really think that is not going to happen. And so I think what we have to do is we really have to wait and see what happens. So anyway, that's, in a nutshell, the economy is starting to recover. Unemployment is improving faster than anyone expected. Retail sales have already recovered. There are concerns, Kelley, but, as I mentioned, I think they can be confidently, successfully dealt with eventually. And as far as the presidential election, I honestly think no one can be confident about that. Either candidate is obviously worse or better than the other. As far as the economy and markets are concerned, only that. Don't forget that a lot of people thought that the markets are going to crash under Trump, and just the opposite happened. Anyway, that's it for me. Thanks for listening, and I'm going to turn this back over to Kelley, and I think we have some time for Q&A, and so I hope we do. So I'll go back to you, Kelley.
Yeah, so thank you, Ken. I so appreciate your insight, that's for sure. I did want to mention, as far as volatility goes in the market, so I started in the business, as you know, and all my clients here know that in 1982. So I've been watching this for a very long time. Back in 1982, we didn't have big swings in the market, up 1,000, down 1,000, right? We didn't have that in those days. We have that now, and Ken, maybe, and this is more of a micro thing, but maybe you can comment on this as well. We have instantaneous news feeds. We know what's happening in China. We know what's happening in Iran immediately. And so the markets react, whether it's good or bad. And it may react one way and recover the next day because they realize, oh, well, we don't really have anything to do with anything. But we have these instantaneous news feeds today, which doesn't serve the market, in my view, but it creates volatility, right? We also have, that we didn't have in the 80s, these computer programs. So when certain markets hit certain spots, all these trades go off, either up or down. And that disingenuously, if you will, makes the market go up 1,000 or down 1,000. And again, the next day it could be recovered and, oh, it was no big deal. But I think we're seeing a lot more of that now. So I always tell my clients that are in the market, expect volatility. So I'm actually not surprised at all this week to see the market doing what it's doing, because we've got an election next week. People are nervous. They don't really know what's going to happen. And so we're seeing that now. And the market probably up to 1,000 tomorrow. Who knows? But I don't know. Any comments on that part of it?
No, you're absolutely right. The thing is like, one, we have much better access to news now. And two, program trading has become, or computer trading or algorithmic trading or whatever we want to call it, has become more sophisticated. And both of these things are causing volatility. And so I think now more than ever, we should just remain calm and stay invested and just know that, that these things are going on in the background. But at the end of the day, it's just staying invested and just not worrying about those things is really the best way to go. The funny thing about it is, markets have become more volatile because we have better information, but they still, and so now when we don't know something, it actually causes even more volatility because we're so used to knowing things. And so I think, with this upcoming presidential election, because we're so used to, having information now and, in this 21st century, because we don't know who's going to win, it's actually caused, more volatility than we might normally expect. And again, that just means that it's just an artifact of our modern times. We just have to remain calm more than ever and just understand that.
Yeah, through this whole COVID situation we were in, back starting in February and through March, April, May, June, I did not panic through this whole thing. I was a calm voice in the storm for all my clients because I've been, like I said earlier, doing this for a very long time, and I've seen certain volatility things happen. Early 2000s, 2008, happens. So we don't panic. We have a plan. We stay with our plan. We do long term. And this is interesting too, because I've had a lot of clients talk to me about this recently. Is okay, well, what's going to happen with the markets, as you said? If Biden wins, if Trump wins, what's going to happen? And how is that affecting the portfolios you're doing for people, Kelley? And I always say, well, look, I project, or I set up investment plans for people 5, 10, 20 years out. There's going to be a lot of presidents between now and then, Republican and Democrat. So I don't base any portfolio scenarios for people based really on who's in office. I base it on what the economy is doing. What's going to be big in the future? Is retail doing well? Is office space doing well? Is computer stocks doing well? I mean, those are the things I look at, not who's in office, because that's going to change. That's just definitely going to change. So I don't base anything on any of that.
Exactly. I sat down for a month thinking about my own personal portfolio, given the upcoming election, and I ended up doing nothing with my own personal portfolio, just because, to your point, exactly to your point.
Yeah, you stay the course. Okay, so here's one question for you, Ken. What is EQIS's overall investment strategy, and how do you choose what to invest in?
Okay, so it's EQIS strategy, what to invest in. All right. Well, at EQIS, we have what we call the EQIS scientifically engineered allocations, and so there are model portfolios, and so these portfolios have about a dozen money managers in them. And depending on your horizon, your current income, your goals, and how much savings you have, there would be a model that would be appropriate for you. I mean, so the nice thing about the EQIS platform is that you can invest directly into stocks, and so it offers something superior to mutual funds. And so the nice thing is that, normally if you want a money manager to directly invest in stocks for you, you would have to have like about $1 million or $2 million account. I mean, you'd have to go to a money manager and say, I want to open up an account, and invest in the stocks that you think I should be invested in. And the money manager will say, okay, I'll do this, but you need to have at least $1 million. Otherwise, I don't want to bother. It won't be worth it for me. But EQIS is a tech company. I mean, what we're able to do is we're able to have portfolio money managers provide us with their portfolios, and we can replicate it with technology, and we can actually put clients directly into securities, and for accounts as small as $25,000. And so that's what the EQIS advantage is really. I mean, so as far as it's hard to answer generally what the EQIS investment strategy is, because we have several, and the only person, and so the question about what to invest in, the only person who knows, who's best positioned to know that would be Kelley, because Kelley's the one that knows you. I don't know you, and so she's the one that that knows you. Knows your family situation, knows what your goal is, and knows what you're afraid of and what you're not afraid of, and based on her knowledge of you, she can make a suggestion as to which portfolio would be best for you. And I am confident that EQIS does have a portfolio that would be best for your situation.
Yeah, so to that point, so why have I picked EQIS as one of the money managers that we work with? Well, it was mostly because, well, I met Ken Kim and he was fantastic, but also they buy individual stocks for portfolios. They don't buy mutual funds. And actually, Dr. Kim wrote a book on mutual funds and why they're not that great and why there's fees in there that you don't know you're paying. So when I find a money manager like EQIS that's going to buy individual stocks for portfolios, again, based on your risk tolerance, your time frame, your taxes, all sorts of different things, certainly. So it is hard for Ken to answer that kind of a question because everybody's unique. But I love the way EQIS buys individual stocks for portfolios, which is great. They also can do personalized portfolios to a certain extent. If you want to have environmental companies, if you want to have companies that women run, all sorts of different choices that you can have. And you can tell EQIS, tilt my portfolio towards whatever it is your concerns are. If you don't want to buy tobacco stocks, they won't buy any tobacco stocks. All sorts of different scenarios like that you can choose from that they offer. So they do have quite a range of different kind of scenarios to choose from based on what you want and what you're looking for. So So anyway, that's one reason, that's the main reason why I chose EQIS, because I like it when companies buy individual stocks for portfolios, not mutual funds, because then they're just managing other managers, right? Anything you want to say particularly about mutual funds, Ken?
Well, mutual funds, I mean, they have their positives. I mean, they were invented immediately after the Great Depression. And so, it was a way for, people to be in a professionally managed portfolio. But these things were designed sort of like just for the masses. I mean, when you invest in a mutual fund, you don't actually own the shares in those mutual funds. I mean, in those mutual funds. And so you just own a portion of the mutual fund company, and that raises like this really an awkward kind of an ownership structure. I mean, there's a lot of problems with mutual funds other than just that. I mean, for example, you only know what's in the mutual funds 4 times out of the year. And so a lot of times you won't even know what's in it, which is weird. With holding securities directly, anytime you want to know what you own, you can know it 24/7. I mean, if you're tech savvy, you can look it up, or Kelley can tell you. And then there's a lot of tax disadvantages to mutual funds, and then the mutual funds have all kinds of crazy fees. They have front end loads, back end loads. They have 12B1 fees. It's just redemption fees. It just goes on and on. And they're just complicated. And so it's as Kelley mentioned, I wrote a book about it. If you want, if you're bored, if you want to just Google Ken Kim mutual funds, you can see some people have written some columns about some of the stuff that I've written. You can see some of the other problems that mutual funds have, but they're just really something for the masses. I mean, here's the thing, Kelley. If you ask all the billionaires in the United States, raise your hand if you own a mutual fund. I bet it's not even one billionaire will raise their hand. And so if billionaires are not investing in mutual funds, that means that they have access to something better. And one of those things is they have access to portfolio money managers who will invest in securities directly on their behalf. And so what EQIS is doing is using technology to bring that to the masses.
Yeah, which is great. So I use mutual funds for people that are just starting investments, right? They only have $50 or $100 or $1,000. They don't have 25,000, which is the minimum for EQIS. So until we can get you 25,000, then we're probably going to do a mutual fund for you just to get you going and saving your assets. So. Right. So, there is a place for them. I'm not going to say I never use them, but I really love the way EQIS buys individual stocks, individual securities. And yes, you can look at them every day. I do tell my clients, please don't look at them every day.
Don't look every day.
You can. It's available. All right, we're going to wrap this up. Ken, I wanted to say thank you so much. I love the positive outlook you have on the markets in general, and based on all the numbers and the data you gave us tonight, you made a great case for it. So I am positive about the markets. Again, I have my personal preference as far as presidents go, but I don't base my portfolios on who's going to be in office, because it's going to change in 4 years, 8 years. 12 years, 20 years, it'll be changing over time. So I always look to the future as far as what looks good for a total portfolio. So I love your positive outlook. That's great. I also wanted to mention to everyone, I do have an evaluation form. Erin, my assistant, is going to email it to everyone as far as filling that out. It's really important to us. These Zoom meetings are relatively new to us. We haven't done hundreds and hundreds of them, but we're getting better each time we do them. So please fill out the evaluation form and let us know your comments. If you have questions or you want more information about an EQIS portfolio that we can run an illustration for you, by all means, let us know. So by all means, fill out that evaluation form for Aaron when he sends it to you. So with that, I'm going to thank you, Ken. So appreciate you taking the time. I really, really do appreciate it. Your knowledge and wisdom is always fun to listen to. So thank you so much.
Thank you, Kelley. Have a good one. Have a good day. Have a good day, everybody.
Okay, bye.